Hey, thanks for joining us. And if you had not had an opportunity to see our Tuesday night podcast, we did something completely different. I had a completely different video scheduled to post, but because of all the comments and the current situation with the housing market and all the news that everyone is kind of wondering what the heck's going on. And so we decided that I would just go live. I appreciate your comments. The live show was overwhelming. We had almost 500 people in chat watching, a lot of comments, a lot of the same things. People are concerned. Should you be buying a house right now? That is the question. So let's go ahead and recap.
Tuesday night was definitely a different feel type of podcast. You guys had an opportunity to see Todd in a very intimate setting, talking one-on-one, answering your questions. We will do more of these sporadically in the future, but it was really overwhelming, and we are very thankful for all of the participation.
So Compass and Redfin announced just earlier this week that they would be doing layoffs. So, I had posted a video about a month and a half ago where I was saying that the housing market was going to crash, or it was here, and that it would turn more to a buyer's market. And, I had a lot of peer scrutiny, other agents kind of wondering why I would mention something like that. And a lot of comments where people were saying, hey, you don't know what you're talking about. Where do you live? Like I'm under a rock somewhere. And we're seeing it now. And when we see big tech giants like Redfin and Compass, which is another very large real estate company, they are publicly traded. I have friends that are at both of these companies. And when we see them announcing layoffs now in the news, it's kind of settling in. We had such a run for almost 2 years since the beginning of the pandemic when America kind of pulled back. We were all stuck in our homes, literally, and the economy crashed, and the Fed wanted to stimulate the economy. I guess whoever thought it was a good idea for us to be in debt is really the question. We are a nation that always seems to get ourselves in debt as consumers. But they thought it would be a great idea that they would stimulate this economy and kind of drop where central bank lends money, their interest rate to zero, basically free money, just come and get it. And what we saw with that are the results of what we're seeing right now. Mortgage rates dropped to all-time lows through the history of lending. In fact, we can pull up a chart right now from Fred, and it kind of dates back to the early 70s. And, historically with a 30-year fixed mortgage rate, and you can see that what I'm talking about here, that by central bank, one of the effects was that the interest rate for mortgages dropped to all-time lows, actually went down to, at its lowest point, 2.5%. And it just caused the buyers to overpay, just offer whatever they needed to do to get the house. And then, we all know the story. If you tried to buy in this time and you're unsuccessful at that because your offers were outbid and you didn't have enough cash, it sort of put us into where we are right now.
And a lot of people also refinanced with that lower rate, which just means they're staying put. They're not going to be moving, which added to the low inventory.
Which kind of resembles what happened back in the 1970s. So, when I was, a kid growing up through the 80s, you didn't think about it back then, but my friends' parents never moved. So, from the time we were born until we graduated college, my friends graduated college and things like that, our parents never moved from the houses that we grew up in. And one of the reasons was because in the 70s, there were just crazy times with interest rates that were fluctuating, but you could buy a house back then in the 7%, 8%, and 9% range. Well, once we hit to the 80s, we had historical high interest rates along with inflation from the late 70s. And basically the interest rates shot up into 18%, the high double digits for a typical 30-year mortgage. And what happened was they didn't buy. They didn't sell their house and they didn't buy any houses because, why would they, right? They were going to sell their house where they were locked in at a 7, 8, or 9% interest rate. They were going to, buy something that was a lot less than what they had and for a lot higher price because the interest rate. So that's exactly what I think we will see now as these homeowners have refinanced their houses for now, on average 4%, let's just say, on a refinance. And a lot of the buyers have purchased their new houses under 4%. So as these interest rates are soaring, they're going to stay put.
As you said, the rates are rising. Let's hope we do not get back up to 18%.
And then what happened in the 80s was they came out with these adjustable rate mortgages, and they were called ARMs, and they would lock in the first 5 to 7 years at a low interest rate, that 7, 8, or 9%, and then it would adjust after 5 or 7 years to whatever that rate was at the time. And they did that in a way to entice people to sell their houses and upgrade.
So back in the early 1900s, everyone was migrating to the country, and that's when really the mortgages were established. And at that time, it was a 5-year mortgage, and people would put 50% down on the homes that they wanted to purchase, and they were paying interest-only mortgages.
And that led us right into the roaring 20s. Back then, everybody was buying a home, and what happened is when the stock market crash happened in 1929, there were millions of people that were at risk of losing their home to default. And back then, the interesting thing is there was no government-backed loan. So when the banks used to lend the money, they would use the depositors' money, when people had savings accounts, and they would actually use that money to lend for these mortgages. So when the people couldn't afford to pay, it really put the banks and the consumers, the depositors, in jeopardy. So, a lot of banks went out of business, and then the government in 1938 came out with the Fannie Mae program. And basically what they did was President Roosevelt actually wanted to free up some cash from the banks, lending the money and their hesitancy to continue to lend because there were so many people in default. So what they did was they came up with this program where people could actually finance longer than the 5 and 6 years that Melissa was talking about. That was the original mortgage back in the 1900s, early 1900s. But they wanted to be able to extend the time of the loan. So they went to 20 and 30-year mortgages back then. And then they actually bought the loans from the bank, letting the banks service them, where they could make profit for originating these loans and fees. But they would take these government-backed loans off of the bank's books, and then in turn, that freed up cash. And what they had hoped to do with the creation was to get homeownership up to around 70%.
And by doing this, the lender's risk was lowered by creating more lenient qualifications for the borrower.
Yeah, and then what happened was the government, by creating this Fannie Mae program, they realized that it was very successful, but it wasn't necessarily great to have all these mortgages on their books. And today we're looking at that with these mortgage-backed securities. $2.7 trillion in mortgage-backed securities is a ridiculously high number. But what happened in the '08 crash was one of the things that the government ended up with all these defaulted loans back in '08. But anyway, what they had decided was back in 1970 that they would start another entity called Freddie Mac. And with Freddie Mac, they would buy these loans from the lenders, but instead of holding on to them, Freddie Mac would actually sell those loans, which created the secondary mortgage market. So they would sell those loans to investors. So, it kind of brings us up to today. And I do encourage you to watch that video if you have time. It is long, last Tuesday night's podcast. It was, I think, an hour and 20 minutes, but we were having so many comments that were coming through. And I just felt that, it really was important to connect with our audience. Guys, we love the comments that you're giving us. We've had videos, the last couple videos, we've had videos where, over the last month and a half that have hit well over 100,000 views. And to me, that's really special. It's really important, not that that we're getting so many views, but that the messages are reaching people. And I think it's really important that being in this business, that I deliver good, valuable content, from the 33 years that I have in this business so far, from one aspect or another, serving the real estate industry. that you kind of hear my take on it and what I'm seeing and finding, whether you disagree with it or not, or agree with it. And guys, I'm not trying to be right. This isn't a matter of me being right or wrong. What we're trying to do is keep you informed of what's going on.
We hear your struggles, we hear your confusion, and it's wonderful to have that opportunity to be able to address you one-on-one in broadcasts like that.
So before we close this video out, I just wanted to bring your attention to something that I thought was very interesting. This is a Fred median sales price of homes through the history dating back in the early 1960s. And there's two things that I want to point out. And the first thing I want to do is disclose that this dotted line is something that I created. This is not something that was provided on the Fred site. And I'm including these links below in the show notes of the two charts that I'm showing you here. But what I wanted you to see is when I was laying out this, and it seems like, markets in the real estate business is no different than any other financial market in many ways, because there's running averages that go through periods of time. And as you see in this chart, and I'm not a financial advisor, but as you see in this chart, dating back from the early 60s to today, you can see that real estate prices have risen with the rate of inflation. So, which over time has been 2 to 4% throughout the years without these exuberant times of, excitement in the market. And so this line is really reflecting what has happened. And I really want to point out two times really in the early 90s or the late 80s, early 90s, where we see here we've gotten above this line of average. And then what I want to show you is that from really about 1990, the real estate prices flattened out for the next couple years. And then they kind of went up with inflation until we really got into pre-2005, which is the lead up to the major housing collapse that we know as the crisis of 2008. And you can see that this line that I drew through here, we well exceeded that line with exuberance. We know it was exuberance because hindsight is always 20/20. So people overpaid. It was a time when we had no documentation loans. We had, real estate prices were a runaway train, but not as bad as they've been in the last 2 years. But the important thing that I want to show you here is that the market always seems to speak and balance itself out from the major upswing to some type of correction. And as we see here, really from 2008, which we'll call the bottom, in this gray bar, each one of these gray bars represent some type of recession period. But as we see that these prices really kind of danced around and kind of went sideways and still went up over time until we really got to around 2013, to where we started seeing where the sales prices, if I redrew that line, started to get back to the pre-2008 level. And then as we see here, once we get to 2020, guys, the line almost goes straight up. But the important thing here is that since 1960s, we have never seen this kind of spike in housing. So the question's always been, is it a bubble? Well, when you look at a chart like this and you start seeing what happened to the home prices from 2020 to where they are today, if you were to ask me, is it a bubble? I'd say, yes, it is a bubble. If you ask me, what I think about the home prices, I think we're going to get down below this line of that I'm drawing here of averages. So if I were to bump this chart out and show you some forecasting, what would have to happen is that line, or that average line, in my opinion, would need to go somewhere over the next 5 years or so, maybe even 10 years, on this inflationary angle, this law of averages kind of thing. And then one of three things could happen if you want to believe that. One, which I don't think is going to happen, is the real estate prices would continue to rise. I don't see it happening simply because interest rates will rise and people just can't afford the median home price with the rising rates. Maybe at 3% they could, 4%. We starting to get over 6-7%. It's hit over 7% this week for decent credit applicants. we start getting those numbers and we're talking about 40 or 50% more in your monthly payment than it was a year ago. But so three things could happen. You could believe that the house pricing would continue to rise from this point on, or you could think that this line would flatten out like we saw in the early 1990s, that this line could flatten out and somewhere hover and lay stagnant until it hits that 5-year or so or 10-year, wherever that line would go with inflation mark, to where then it would continue to rise from there. Or you would believe what I believe is that it will drop below this line somewhere, which could in many markets mean 30%, 40% to where we are today.
Looking back and looking at the history, it does appear that what comes up must come down. We'll see if, which one of those three scenarios plays out, but fascinating information.
Yeah, I would say that exuberant times, what comes up goes down. The market fluctuates up and down, but certainly when we see the market respond to exuberance, we know why these prices went up. I mean, it was a perfect storm. I think the Fed should have raised the rate last year. They knew that housing prices were going up. Inflation was a runaway train. And guys, I'm really, I'm concerned about the market, not trying to hit any panic buttons, but I think that if you're interested in buying a house right now, today, you need to make sure a couple things. Number one, your job is stable. Number two, you have some money left over in the bank after any money that you need to put down. And number three, you need to think about staying there. We want to see people feeling confident that they don't need to sell in 3 or 4 years. Of course, you never know. But if you do have to sell in 3 or 4 years, you may not get what you paid.
Yep. Very good points.
Yep. So guys, we appreciate you listening. Thanks so much. If you like this video, you can let Melissa and I know that you do by hitting the thumbs up. And guys, we love it when you subscribe and hit that alert bell, because we know then you're going to continue to get the content as we post it.
As always, we value your comments and questions. Keep them coming.
See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.